news, see what's going on. Reminder, because Monday was a holiday, today there is no um, crude oil inventories. I know that we're accustomed to seeing it on Wednesdays, but it's not. Um, Not today. It'll be tomorrow. And a lot of news tomorrow. Not a lot going on today. And it's weird because it's all tentative. Always looking for the news, seeing what's going on. Tentative makes it difficult, right? How do I know when it's going to happen? I believe they put tentative because of the shutdown. So they're trying to figure out tentative events are subject to delay, revision, or cancellation. Typically, core CPI is an 8:15 thing, but that is tomorrow, so we'll talk about it. Um, I'm slow rolling today because I can, right? One of the things, if you haven't seen it yet, I'm assuming everybody gets the notice. John Novak has the classroom on Friday. Pretty exciting. He is going to go through um, the looks for setups, same thing we talk about here. He's not going to give you rules that aren't real rules, guys, that aren't what we talk about here, but he's going to talk about management techniques once you're in the position. How to align your logic, signals, execution for maximum results, guys. He is excited about Friday, and when he is excited, his classrooms are amazing. Don't miss it. Everything that I talk about in this room is right from the trading guide. There really are no secrets with Nexgen. A lot of people think, oh, maybe he'll tell us one thing and he'll hide answers from us. Guys, there's nothing that I keep from you. All you have to do is ask a question. But what I can't do is I can't tell you every possible way to use the software because, guys, there's a million ways to use the software. So what I do in this room, here's my segue to it, is I teach you to read indicators. That's my job, and I love my job. I teach you how to recognize advantages so you can make good decisions. That's the short version. Like if I had a business card, that's what it would say. Because you've got to learn to read your charts, guys. I posted in the room that word should. Man, it's a dangerous word, guys. The market should go up. The market should go down. This trade should win. It's one of the most dangerous words in trading, I think. So we're going to try to realign our thoughts. We're going to try to shift our focus from it should to the magical phrase my indicators say or my rules say. So we're going to learn to read these indicators, these amazing T3 indicators, guys, and we're going to do it with a lot of simplicity. I'm going to hand you a checklist and a plan. There's only 3 rules that we're going to talk about. It only takes 2 charts, so we're really going to keep it focused on the best of the best and building a foundation as you learn to read your indicators and recognize these advantages, guys, because these advantages become your trade. So chart reading is about 90% of your day. Most of us are not pleased with that because if I sit in front of my computer for 6 hours, I don't want to do nothing for 5 hours and 24 minutes. That's a long time to sit on your hands. Guys, there are plenty of games on the internet. I play Scrabble a lot. 10% of your day is actually trading. 90% of your day is just waiting for an edge. And an edge means that you can identify a pattern that you can prove wins more than it loses. That's what we're going to talk about this morning, guys. And once you get your chart reading down, you're going to know where the market is likely to continue, where it's likely to go, where it's likely to stop. And these are the concepts that you're going to use for entry, for management, and really for embracing the 90%. We talk about 3 advantages in this room: momentum, path, and entry, every time. You could throw direction in there, but direction is a byproduct of momentum. Um, when all 3 advantages that we're going to talk about this morning are true, you have a high probability trade. You have a trade that you can look at it and you can say, man, this trade is just a pattern, and that pattern I can prove wins more than it loses. I can prove that if I take it 100 times, it'll typically win 70 to 80 times, which means that you've also proved that it loses. And anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. So the focus is consistency of execution, doing the same thing every time so that you can create expectations long term. Guys, high probability trade is the best of the best. Each indicator on every chart agrees with the rules for the trade. Once you understand momentum and path, it'll change your life with the software. Once you understand momentum and path, you're going to begin to recognize medium probability trades. You're going to begin to recognize low probability trades, and you'll say that before you enter. Okay, this is the best of the best. I better not hesitate. Or this is medium probability. I need to manage. Or this is low probability. Why on God's green earth am I pulling the trigger? And only you control the entry. Nobody's going to make you enter the market, guys. Nobody's going to say you have to take this trade, even though it's not perfect. You can choose not to. That's the hardest thing about trading. But when you know what's working for you and you know what's working against you, it helps you make decisions, guys, not only on whether you're willing to enter, but also on how aggressively you may need to manage it. Management is where the money is made. I'm going to tell you that right now. Management is where you guys excel, and management is easier from great entries. So what we're going to do this morning is we're going to talk about NinjaTrader first and foremost, because most of you are on NinjaTrader, and then we're going to follow it up with TradingView. Here's my little picture reminding you that it is apples and oranges. There's a lot of similarities between the two. Nexgen Pro Trader funding people are using TradingView. When I talk about the TradingView plan, guys, I'm literally laying something in your lap to pass those evaluations. NinjaTrader is what we've been doing for quite a while, so I'm going to start there. But each one will come with a plan and a set of rules. And your job is to learn the rules. So when I talk about learning the rules, there's a KISS plan, keep it simple, for both NinjaTrader and for TradingView, guys. They come with the rules, pictures of what it means to have the rules met, even checklists for entry. But these plans are a stepping stone. Very often we want to cross the finish line before we ever lace up our shoes, guys. This plan, both of these plans are stepping stones. These are the best of the best. These are the ones that are going to help you learn to read your indicators, to recognize advantages, guys. And the trades in these plans are designed to optimize your chances of success, which means the trades in these plans are those patterns that you can prove, you can backtest, you can verify, win more than they lose. And then it's going to be through study, through simulation, through class feedback and practice, guys. You're going to write your own plan. There's no doubt in my mind. You will see more, and you will probably stray from the plan. I would say 75% of the people that break outside of this plan break out of it too early, before they're ready, before they're making money consistently in the easy way. Victor just put in the room, and they work. The rules work. They do. You've just got to learn them. So that's what we're going to do this morning. We're going to talk about the rules for both platforms. Everybody in the room, boy, put your listening ears on. Simulate, right? Absolutely no risk of financial loss as you learn these patterns, but post your pictures in the room. Show me what you're doing. Tell me how you're reading your indicators. Tell me why you're doing what you're doing. And my promise to you, all of you new people that are just coming into this, we'll have a private session. So Orlando, you drop a picture in the room and you say, hey, Mark, check it out. This is what I just did. This is how I saw momentum. This is what I thought of the path. This is where I entered. This is where I got out. How did I do? And we'll go through it, each of those three concepts individually to make sure that your read is accurate. We'll go through your entry, talk about your stops, make sure they're in the right place, make sure that profits, we're taking it at an appropriate spot. And if there's anything that you guys can do better, anything that could reduce risk, anything that could maximize your profit potential, we'll have a conversation about it right there in the moment. The goal is that you're taking the correct trades, guys, that you're practicing the rules, because the rules are what provide the edge. When people come in on simulator, first of all, you will make mistakes. Making mistakes is not practicing the wrong rules. Making mistakes is learning the rules. And every time you make a mistake, you'll be given something to help correct it. But ultimately, guys, those man, let's just jump in and see if it works. Let's add 50 contracts and see if I can be amazing. And what happens, guys, is you make that 10 grand on simulator trading like an absolute yahoo, but your brain believes that you are just an amazing trader. And that's when people go live too soon. And that's where challenges happen in the real world. It's what we call a short-term victory providing long-term failures. So at least focus as you're learning the rules to trade the rules, but be willing to make mistakes. When you drop it in the room, we'll identify any challenge, and every identification of a challenge comes with corrective measures. And then, guys, keep it simple. Um, the plans that I give you have the Ninja Trader plan has 2 trades in it. That's it, a high probability trade and a medium probability trade. The Trading View plan has 1 trade in it, the only trade that you'll ever need to be able to read these indicators. You've got to learn the looks. You've got to know what the pattern looks like. That's the second piece of getting to where you want to be. So I'm going to drop in the room right now. Whoops, that's not it. I'm going to drop in the plan for Ninja Trader. I'm also going to drop in the room the plan for Trading View. And then I'm going to include these spreadsheets, guys. There will be one for Ninja Trader. There will also be one for Trading View. And these spreadsheets are your study tools. These spreadsheets are going on the idea that repetition creates recognition. So when you look at the one for Ninja Trader, there are strong triggers, rule number 1, highlighted in green, over 50 pictures of what it means to have that rule met so you can commit that look to memory. The idea of a clear path, nothing in the way that could stop the market. Again, there's about 18 pictures here, maybe a few less, but they're all the same. They're all annotated. They're all showing you exactly what it means to have that advantage on the table. And then entries, guys. And as a brand new user, rather than trying to find the money, look for the advantages. And what you'll do is you'll string these 3 advantages together to create the perfect trade. In red is what it looks like to not have your rules met, when the triggers aren't strong, but rather they're weak. That's part of your 90%. When it's not a clear path, but there's a termination condition in the way, that's part of your 90%, guys. And then the second tab are client trades, about 500 of them, of the exact pattern that you're committing to memory. So repetition creates recognition. There's the entry sequence, guys. There's management ideas. There's patterns that begin to repeat themselves that you'll notice outside of the plan. There's a place for you to put your pictures, to build your trading plan. And then finally, there's a trade tracking sheet. Now, the trade tracking sheet, we like to avoid it because it feels like work. I'm going to tell you exactly how this trade tracking sheet paid amazing dividends in my life in the last 2 days. So I had two I will say, mistake-filled days. I had formed opinions, and when I came back and I looked at my trades, I kept seeing early entries. I kept saying it should go up from here, but I didn't wait for the entry rules to be met, guys. Yesterday, I gave away $1,000, and then finally I went back, stopped trading, reviewed my trades, and said, oh my gosh, that's 5 early entries, costing me money. So I sat on my hands, waited for the correct entry, made it all back plus some. But when you track your trades, guys, and you go back and you study what you did yesterday, you begin to see the patterns. You see the patterns that are bringing you success. Those are the trades that are working. And you also see the things that aren't taking you to the promised land, guys. And this is your thing. Everybody has a thing. Mine was trading into areas at first, and then it became exiting trades too soon, and recently it became entering too soon. And I had to go through and identify that and fix that, guys. And if you can't see your thing right off the bat, that's where you come to the classroom, where you show me what you're doing. We will identify your thing, we'll talk about your thing, and we'll talk about how to fix your thing. So learn the rules, practice, 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 guys. Take a million pictures and keep it simple, keep it focused. Learn how to be successful the easy way. There's time to find more. I wanted to share this because we talk about taking pictures, guys. I just hit 10,000 pictures for the year. 10,000 pictures. That's a lot of pictures in 11 months. The more pictures you take, the more you annotate charts, the more, even if it's not a trade, every time you type on a chart, it connects your brain with what it's looking at, and it makes trading easier, I promise you. So Nexgen's going to give you the analysis, guys. We're going to teach you how to read your indicators. All of us together. I'm going to hand you the rules, and I'm going to give you the coaching if you accept it, guys. You will be responsible for becoming the profitable trader. You will be responsible for taking pictures. You will be responsible for annotating charts. You will be responsible for posting them in the room. And guys, I love it when you post in the room. The first three are scary because what if you're wrong? Guess what? You will be. That's okay. We're going to identify why and work on fixing it. I am here to help, guys, but you will get out of the software what you put into it. I'm going to tell you right now. And someone said the other day, the world's most expensive elliptical sitting in the basement doing nothing isn't doing anything to fix your weight problem. You've got to do the work. And we're going to do it with only 3 rules. That's it. 3 rules. When a rule is true, it creates an advantage. So rule number 1, strong triggers, gives us the advantage of momentum. This is a market that's hard to stop. Rule number 2, terminations false. You're going to have room to profit targets. No likely to stop the areas. That's going to give you the advantage of a clear path. This is your foundation. You're going to see people posted in this room trades that are based solely on momentum and path. There's momentum, there's path, there's the winner. Nice job, Pete. That was very timely. And then finally, rule number 3 is specific to a trend trade. And all it does is it defines the perfect entry, guys. It gives you the advantage of identifying where the market is most likely to continue, allowing you to reduce risk and maximize profit potential. So 3 things, that's it. 3 rules, 3 looks, 3 patterns that create a trade. It only takes 2 charts to do it. The large chart, the big chart, the slow chart, guys, it's a broad stroke of a brush. It will define direction, momentum, and areas, and it'll do it with the most current bar. That's it. Takes 1 bar to get rules 1 and 2 met, to have 2/3 of your advantages. Oh, guys, can you hear me? Rob lost me. Oh, okay, cool. Just want to make sure. Guys, if you ever can't hear me, do what Rob did. Just let me know, and I'll ask the room, and if you see a bunch of yeses come up, it means that it might have been on your end. Good to see you, by the way, Rob. Guys, strong triggers, direction, momentum, and areas. 1 bar, that's all it takes. Your small chart is an entry chart. And remember that the small chart is an entry chart, that the small chart is where you are taking advantage of those first 2 advantages. And inside of that 1 bar, you're making a decision to take a trade. Hey, good morning, Justin. Good to see you, man. And down at the very bottom of this bar is where the magic starts on the small chart, and you're going to see a retracement. It's a small move counter to the underlying trend, and you're going to see it pull right back to areas inside of triggers. When the rules are met, that becomes your entry, and if everything's working out, you're going to see continuation and probably first profits on your trade before you ever get out of the 1 bar that told you to get in. So we use the smaller, faster chart, that x-ray of the large chart, and this is how we're going to pinpoint entries, reduce risk, and maximize profit potential. And then again, the favorite analogy, guys. Believe you're not in charge. Who are you trading with? Who are you trading against? If you are allowing the large chart to lead the way, as the plan suggests, guys, if you are defining momentum and areas on the large chart, you're going with the people who are in control. The large crowd creates those trends. They establish that momentum. They react at key areas, and your plan is designed to keep you in step with them. Your small chart is like a small crowd, and I don't know, maybe trust fund babies, whatever. They've still got a lot of money, and they're pumping it into the market to create that little push that fights the large crowd. These are the ne'er-do-wellers, the rebels. Guys, rule number 3 is designed to put you into the market precisely where their failure is most likely to happen, and they typically fail 70 to 80% of the time when the large chart rules are met, which means that by pinpointing their failure, you're entering the trade that is the highest probability trade that gives you the potential to win up to 70 to 80% of the time. It is 1 pattern. That's it. That's what we're learning. We're going to talk about the indicators on the chart before we get into the rules, guys. Anytime you hear areas in this room, anytime you hear areas, it's a horizontal line on a chart. That's it. Areas can be divergence highs or divergence lows. Divergence means that there was a loss of momentum right at this pivot, and you see it through a magenta line or a cyan line. So anytime you hear divergence, the advantage of momentum is going away. You're going to see red Fibonacci resistance and blue Fibonacci support. Guys, these Fibonacci areas are the accumulation of tens of thousands of calculations with the Nexgen algorithm sorting them out, giving you very precise areas where tops and bottoms happen, where reversals come from, where fights take place between the large crowd. You're going to know about them long before you ever get to them. And then you're going to see yellow 1-to-1s. These are fibs that print in the moment. When the rules are true, it's a 100% Fibonacci alternate. You will see it. The people in charge see it. They use them for targets. They use them for entries. And then you're going to see the mid-band. And this is just a moving average. If it's green, prices above it, it could behave as support. If it's magenta, prices below it, it could behave as resistance. Areas have a different role depending on the chart. On the large chart, these are the spots that could stop a market. On a small chart, these are the areas where your trade will originate. So know that you have names. You don't even have to know how they're created. Trigger lines, the other indicator we're going to talk about. There's two. There are small triggers. These will be solid. There's large triggers. These will be dashed. Small triggers are a fast-moving average. I don't know the numbers that go into it. I'm not that smart. But I do know that they look the same whether it's a big chart or a small chart. Large triggers are a slow-moving average. Dashed lines, they're going to look the same no matter what time frame, guys. You're going to use small and large triggers to define momentum in rule number 1. You're going to use small and large triggers to define termination conditions in rule number 2. You're going to use large triggers to define your amazing entries from rule number 3. You are learning to read trigger lines. That's kind of the crux of everything that we do. So I'm going to break down each rule individually. We're going to talk about the advantage of momentum that springs from strong trigger lines. And if that rule is in place, we're going to talk about how to identify a clear path, making sure that there are no termination conditions. And then and only then, if these two rules are laying on the chart, brand new users, we're going to go define an entry. But it starts on the large chart, and it starts with strong triggers, guys. This lesson is one slide long. Strong triggers either are or they are not. In an uptrend, when your background is green, you will see small triggers break above and away from large triggers. All the colors match. They have to, or you don't have strong triggers. It's this space right here. Looks like scissors that are opening. That space, no matter how large or how small, lets me know that the odds are favorable for the market to continue in the direction of the trend. This is your strong trigger look. Separation means strength. In a downtrend, when the background is red, smalls break below and away from the large triggers. It's the space that's created that lets you know that the odds are favorable for the market to continue down. Separation is strength. That's your strong trigger look. Guys, it's the first bar that is going to let you know that you have that advantage. It'll be the first bar. So if I bring up, that's a horrible example because that's a strong trending market. Let's go to the S&P. The first bar, the most current bar. Small triggers are below the large triggers in this downtrend, but the large triggers are still green. I don't have strong triggers yet because strong triggers is always separation when the colors match. So guys, this would be your 90%. There's strong triggers up. That's what it takes to break areas. Dollars to donuts. Someone in this room found an opportunity right there with all of that momentum to take a trade, to find a way to make some money. So strong triggers is always separation and the colors matching. It's the very first bar. If you don't see it on the first bar, rule number 1's not met. Is everybody good with that? It's the same look always. And if you really want to commit it to memory, go look at 50 pictures of it. Let's see what this picture says. Smalls below the large, all red, space between, momentum, rule number one met. It's the exact same look. And then when the smalls work their way inside of the large, when there's no longer space between the two, guys, rule number one is no longer met. This is what we call weak triggers. And when I have weak triggers, there it is again, this is where reversals are more likely. This is where Fibonacci areas are more likely to hold. This is where the advantage of rule number one is no longer in play. So brand new users, first time users, let it either be momentum or weakness. And only one of these takes you to look for rule number two. Is everybody good with that? That's the easiest lesson that I ever teach. Separation is strength. If you don't have it, it's not strength. But if you do have it, we're going to make sure that you have a clear path, guys. Clear path means that there's no termination conditions. No termination conditions means that you're not somewhere where the large crowd has gotten. They react to these areas on the large chart. So it's a Fibonacci-based indicator that may reverse the market. I like to simplify that phrase. It's a horizontal line on the big chart. That's it. Anytime they get to a horizontal line on the big chart, there's a recipe. So price reaches the area. The large crowd pushes the market up into resistance. The large crowd pushes the market into support. When price reaches the area, I want you to ask yourself out loud, where are my triggers? If all four trigger lines remain below Fibonacci resistance, yellow 1-to-1s, or a divergence high, if all four trigger lines remain above Fibonacci support, yellow 1-to-1s, a divergence low, that area is a termination condition. Because it's a termination condition, rule number two says absolutely no trades into the area. Guys, once you learn this recipe, it opens the door for everything else. Sometimes a termination condition can stop a market. It can create a big, ugly, untradeable bounce. It could create a full reversal, send the market screaming the other direction, or it could break. Now here is the sad truth. It's not sad, really. It's actually a pretty amazing truth because you have the perfect recipe. You ready? I'm going to type it out because I want you guys to follow along and see it. You will never know what the reaction will be. This is going back to, if you say it should, you're wrong. If you say it will, you're wrong. I just want you to realize you will never know. So rule number two is designed to keep you from trading your opinions, but rather trading what the indicators are telling you. If price reaches a line and none of the triggers get through, absolutely no trades. Does that make sense? Everybody good with that? Because let's see if we have some spots here. There's a pullback to 1-to-1s. There's Fibonacci support doing its thing. There's divergence highs doing its thing, right? Over and over, look how rule number two defines consolidation. Price reaches a divergence high, no triggers. Pulls back to support, no triggers. Back to a divergence high, no triggers. Back to a divergence low, no triggers. Back to a divergence high. Guys, rule number two, keeping you out of consolidation, keeping you from forming opinions. And you're going to see this a lot. So rule number two is designed to help you embrace that 90%. But areas break all the time, typically with momentum. If they didn't break, we would be range bound forever, right? We just saw it. So here's what it looks like, guys. And this is, if you begin to learn this process, price reaches Fibonacci support. Price bars reach Fibonacci support. Once they get there, I'm done with price. Has nothing to do with price anymore. My trigger lines will tell me everything I need to know. If none of my trigger lines, all four trigger lines, remain above Fibonacci support, I don't know what's going to happen. It's a termination condition. I have to sit on my hands and I have to relax and I have to say, let's see what they do rather than predict what I want them to do. And guys, this is just kicking back. Every line will be a termination condition, at least for a moment. And if you're not already in a position, just don't start a new one. That's what the rules tell you. But areas do break, guys. And if the smalls absolutely smash through that area, if the smalls break through below, you have momentum. Now this area has the potential to break. This is what we call the 50-50 look. This is the second trade on your plan. This is not a high probability trend trade because rule number 2 is still not met. But guys, this will be the majority of your trades. And once you understand momentum and path, you're going to find ways to capitalize. And I gave you a plan how to enter with the highest chance of success. If you really want it to be the best, let 3 trigger lines get through, guys. You can do it with 2, not as high probability, not as likely, but with 3 trigger lines, that area has the best chance for a breakout. Once 4 trigger lines get below the area of support, now we consider support to be broken. Not price bars, not price peeking its head through, not color change. 4 trigger lines get below support. Now support's in the rearview mirror, guys. Now support is behaving as resistance. Now the path is clear, and your path will remain clear until you hit the next line. And once you hit the next line, you go right back to number 1. Is everybody good with that? Every line will be a termination condition when it's hit. Every line. So if you're not already in a position, wait for the reaction. Let the large crowd make decisions. Let them fight it out. You don't have to be a part of their decision-making process. If 3 of your trigger lines smash above with all that momentum, now it has the potential, a lot of opportunity there, but it's not broken, not clear, until 4 trigger lines break through. Now your path is clear and resistance behaves as support. So I'm going to give you guys this. This is your cheat sheet, and the likelihood of success is color-coded. No triggers through the area, no trades. It's a termination. It's bright red, like a stop sign. 2 triggers through the area. It has the potential, but it's still a red number. This is not your best look. 3 triggers, now we're going to go caution, yellow. I can take a medium probability trade, but without a clear path, I am going to lean heavily on momentum and entry. But once 4 triggers break through, guys, it is beautiful. Now the path is clear, and because the path is clear, if I have momentum, I'm going to go look for an entry, guys. And the easiest trades you will ever take, and I don't care if you're brand new or if you are seasoned, will have momentum, a clear path, and you will be able to define the perfect entry on that smaller, faster chart. These tails on a large chart, that 1 bar that gives those first 2 advantages, that's the pullback on a smaller, faster chart. We're about to learn how to pinpoint exactly where those tails are most likely to form. But that's the best of the best. It doesn't happen every 10 minutes, guys. Sometimes it doesn't even happen every hour. But you can go back to a large chart and you can see that with the potential to break, there's one of those tails. And let's see if there's another one. All that momentum hadn't hit the blue line yet. There's a potential entry. All that momentum, potential to break, there's a potential entry. We're going to come back and look at these in just a minute and see if there's any truth in that recipe, guys. Is everybody good? Can you give me a why? If price reaches an area and no triggers break, it's okay to do nothing? Because that's 90% of your day, my friends. 90% of your day is sitting on your hands doing nothing. 90% of your day is texting your wife, telling her you think she's pretty, can't wait to take her out to dinner and buy her something nice with your amazing trading. Guys, there's going to be times when your areas are stacked, when it's multiple areas and you just can't seem to get past that termination condition. That's okay. The futures markets trade an average of $220 billion hourly. The S&P exchanges about $74 million a year. The NASDAQ exchanges about $269 million. I'm sorry, every day, not a year. Guys, there is so much money going back and forth in this market. You don't have to be in every move. You don't have to be the first one in. You don't have to be the last one out. You can use momentum and path and find a way. And guys, if you spend any time in my room, you're going to know that the potential to $400 or $500 a day is evident within the first 2 or 3 days. And a lot of you people don't realize, that $300 a day is $75,000 a year. It only takes $400 a day times 252 trading days a year to find yourself in a 6-figure income based on your trading. Now the question is, are you going to do it the easy way with the least amount of stress and the highest probability, or are you going to look for every tick in that market, believing that it belongs to you, frustrating yourself, giving away money when you shouldn't? The new users, the second answer is probably your answer. That's okay, you're going to work through it. But once you can identify momentum, strong triggers, it's one look. Once you can define termination conditions, it's one look. Price reaches, where are my triggers? Now you're going to go define entries. Now we're going to pinpoint where that tail on the large chart is most likely to form on the small chart. And the entry rules are so specific, guys. They're so accurate. They're so precise that you're going to use a limit order to buy or sell a pullback on at an area, fibs, mid-bands, yellow 1-to-1s, and those areas need to be inside of triggers, guys. And it's one phrase. Where am I looking? Here we go. When the large chart says up, when the large chart has momentum, when the large chart has a clear path, price is at the very top of the bar. You're making decisions. That's where the small crowd fights. You are going to buy or sell a pullback, their little shove. You're going to do it in an area, at a fib, at a mid-band, at a yellow 1-to-1, and that area is going to be inside of triggers. So on your entry chart, large triggers define the retracement zone. You have two sets. You have the smooth. These are native to the 5-1. These belong on the 5-1 chart. These are how you can define momentum on the small chart, separation between the small and large. And there's the stepped triggers, guys. And these are the large triggers from the large chart. And this is where the idea of them being moving averages comes into play. There's this idea, it's mathematical something or other, that says regression of the mean, price returns to the average. So the large triggers define the regression of the mean. They define the retracement. That's so much easier. Somewhere from the top of these triggers to the bottom of these triggers, that's where the small crowd's most likely to push down. When you have an area inside of the triggers, that's where the market is most likely to bounce and continue with all of the advantages the large chart was giving. So it's just a pattern. It's a repeatable pattern. If you learn the language, you will call your shots long before the reversal on the small chart ever begins. If you just remember the phrase, I will buy a pullback in an area inside of triggers, you know where to put your limit order before the pullback ever begins. Guys, language becomes very important because language describes the pattern. So when the rules are met, when I have momentum, when the path is clear, this reversal bar right here signals the beginning of the pullback. This reversal bar starts the small crowd fight. And you can say without hesitation, the small crowd is most likely to retrace somewhere from the top of the trigger lines all the way to the bottom of the trigger lines. But trigger lines aren't bouncy. So you'll also be able to say they're most likely to continue to bounce and continue in the direction of the large chart advantages from an area inside of the triggers, from a fib, from a mid-band, from a yellow 1-to-1. So you've defined retracement, you've defined the continuation. Your job will be to activate a limit order just above the highest point of support and hope that the small crowd gets there. And because you've defined precisely, where the market is most likely to continue, because you've activated a limit order, you have defined where the market shouldn't go. And that phrase, where the market should not go, is the beginning of management, of active management, guys. Because if the small crowd can push not only through the retracement zone, but also through the areas most likely to produce a bounce, guys, the advantage of rule number 3 is no longer in play. You no longer have an edge regarding your advantage, and anything below the trigger lines, beyond the retracement zone, is where the market should not go. So we give it 4 or 5 ticks breathing room, but once it gets 4 or 5 ticks below, guys, it's going to hit your stop. You will lose that trade. But you have to remember that anything that wins typically 70 to 80% of the time, it is obligated to lose 20 to 30% of the time. It's a cost of doing business. The key is the consistency of the execution. So any line below the triggers is not an entry for a long trade. Once it gets past that good stuff, you don't know if, when, or where that market is likely to continue up. Large chart will say down. It will have momentum. The path will be clear. You're going to wait for the small crowd to show up and fight. You're going to wait for the reversal bar. It begins the pullback. The reversal bar is not your entry, guys. The reversal bar is losing a little bit of momentum on that small chart to hopefully take you back to the beautiful entry. Trigger lines will define the retracement. Trigger lines are not your entry. And you have to learn the whole phrase. Pull back to an area inside of triggers, not just the triggers. Otherwise, you may be in way too low. This is where the market is most likely to bounce, guys, and this is one of those magical moments. There is one line inside of triggers. If there are multiples, your job will be to activate a limit order below the lowest, closest to the reversal bar, and hang on for the ride, because it's either going to bounce and continue in the direction of the trade, or it's going to run you the fudge over and get to where the market shouldn't go. 20 to 30% of the time, if the rules are met, that's a potential outcome. You will never know if your trade will win or lose, but you can enter every trade confidently, knowing that you have an edge, that you have an advantage, and you can pinpoint precisely where that edge is no longer in play. This is stop placement. Entries for high probability trades do not come from the wrong side of the triggers, because you do not know if, when, or where that market may continue down. It's a pattern. Your trade is a pattern. I can't stress this enough. It's a pattern that repeats itself. This was 2:25 p.m. on the 6th of November, guys. This was last week. And it had momentum and the potential to break. And I saw that tail and I circled it. And that circle lines up with a pullback to a mid-band inside of triggers. Does everybody see it? That's your pattern for a long trade. This is what it's going to look like every time. In 2021, Nexgen reminded people that when you have momentum and the potential to break, you need to wait for a pullback to an area inside of triggers to take the highest probability trend trade. Guys, this slide is 5 years old. Looks very much like that slide from last week, and a whole lot like that one from 2022. And if you go through the client trades, where is my mouse? It's hidden. If you go through the client trades, there's 500 pictures of that pattern, guys. Recognition creates repetition. Now, I encourage, I can't demand, but I do encourage, and I'm going to bring this up, and I haven't done this yet. So you guys are my guinea pigs on my first effort here. Language paints a picture, guys. Language tells the story. So for rule number 1, I want you to learn the phrase, separation is strength. And what it does is it reminds you instantly that if there's no gap between the triggers, that there is no strong triggers. For rule number 2, I want you to remember the phrase, price reaches an area. No triggers through, no trade. That's your safeguard. That's keeping you from hoping things break. This is for the brand new user. Now, rule number 3, this is the most important language ever because this one has the most moving parts. So rule number 3 says, I will use a limit order to buy or sell a pullback at an area, and then here's the big one, guys, inside of triggers. And if you learn this magical phrase, I will use a limit order to buy or sell a pullback at an area inside of triggers. Should we save this one? We can save this. What happens is you call your shots. You know exactly where your trade is coming long before the trade ever happens. And you will literally, when the market is over here, know exactly where your limit order belongs. So let's go back and look at a couple of those circles that we put on the S&P that is struggling to do anything really great right now. And there's one of them. Hey, good morning, Junior. And with the potential to break, there's two pullbacks to areas inside of triggers that continue up. And if I back it up a little bit, I know there was another one in here. Momentum and path, what did it look like on a smaller, faster chart? There's your pullback right to the mid band, right inside of triggers. Pretty cool. Back it up again. There's your pullback right to the area, right inside of triggers. And guys, this is a pattern that repeats itself every day. This is a pattern that optimizes your chances of success. This is a pattern that gives you the highest probability as you learn to read your indicators. Are there any questions about the high probability trend trade, guys? In the plan that I gave you, I'll give it to you again if you need it. It tells you exactly how many charts you need and where to find your rules. It describes each advantage in your checklist, and nobody in the history of this checklist has ever been able to show me less than 70% winners. I encourage you to learn the rules and try. It even talks about management for these trades, where your stop goes, your first stop movement, your first targets, your second targets, taking all of the question and challenge out. And then it gives you entry rules for the second. Learning the foundation, building from the foundation, and creating recognition through repetition, guys. That's my goal in here. The more time you spend taking pictures, annotating charts, circling tails, finding these looks, the quicker you're going to get to where you want to be. The more you avoid it, the more trades you look for, the less likely you are to find success rapidly. Now we're going to go to TradingView. TradingView is different, not better, not just different. It's just a different way to do what we do with patterns, guys, but it's still patterns. TradingView is the platform used by the Nexgen Pro Trader funding people. So this plan that I'm about to give you, if you are in funding and you're struggling a little bit, I'm about to give you the golden goose. You'll notice on TradingView that the indicators are 99% the same. That's not a correct percentage, but work with me here. You're going to see divergence highs and you're going to see divergence lows. You'll see trigger lines, small and large. You'll see mid bands, 1-to-1s. Guys, the only thing that you're not going to see on TradingView is Fibonacci. Programmers haven't been able to figure it out yet. Guys, if you really dig the TradingView plan and you're like, oh my gosh, minute bars speak to me. I have created, with the help of John Novak, the exact same, look at that drop, the exact same looks on NinjaTrader. So up to you, but that's available. But guys, it's still areas, and these zones instead of fibs, these are created by a company called Chart Prime. There are free versions, but they're just broader spectrums, guys. Don't trade into them. These are areas that could stop the market. The time frame is different. Renko bars are faster, guys. Renko bars move quicker. Your large chart on TradingView is a 15-minute chart. And a lot goes on in 15 minutes, guys. We're still going to use it to define direction, momentum, key targets, and terminations. But guys, on a 15-minute chart, here's a great example. You can have a huge move. This was from 46 all the way up to 80 in the next. So that's about a 150-point move, if I'm doing my math right. That's a huge move. That's one bar. So in this particular plan, guys, in the plan that I give you, I've created workspaces that remove all the noise. And your workspaces will take off the large triggers because we don't need them on a chart this slow. And it takes off the background color because we don't need it on a chart this slow. Your 1 minute chart defines immediate strength, immediate, in the now. 1 minute's still a long time, but it's going to give you the immediate strength using the trigger lines, and it's going to define your entry point, guys. It's still big crowd, small crowd, 100%. Big crowd wins more than it loses. So to read your charts, direction is defined by the direction of the small triggers. If they are down, I'm looking for rules to be met to go down with them. If they are up, I'm looking for rules to be met to go up with them. Now this is the KISS plan, guys. This is the basic plan. This is the I'm brand new, I need the highest chance of success so that I can feel confident. It's either up or down. If you can't tell if it's flat, if it's kind of going back and forth, guys, if you can't define direction, they're fighting. That's your 90%. So in this case, does everybody see that the small triggers are up? Yep, good. I'm going to blow up that picture because once you define direction, you've got to define momentum. Momentum is the result of where the most current price is trading. They're the only triggers on the chart, Swathi. Both lines create the small triggers. And since you're on NinjaTrader, it is same lesson every day. And the colors may be different, but there's only one set of triggers. So the smalls are always smaller than the large, but there's only one set of triggers. So here the small triggers are down, here the small triggers are up. But remember, Swathi, that TradingView rules don't fit on NinjaTrader. It's just different. It's too slow. Guys, once you decide up or down, you're going to look for that highlighted price and you're going to ask yourself, where is the most current price in relationship to those triggers that are up? And there's three options. It's either left of them, inside of them, or right of them. And where the most current price is in relationship to those triggers is going to define momentum, but more importantly, it's going to set you up to manage your trades. So if I'm left of the small triggers, this is the strong side of the small triggers, guys. This is where bigger moves tend to happen. This is where 1 minute areas are most likely to break. This is the look that I would equate with odds favorable momentum. And you can do it without the need of the large triggers. Now, if you are on the right side of the small triggers, you're on the weak side. And there's that word again, weak side of the small triggers. Guys, the weak side is where reversals typically come from. The weak side, I'm still looking for maybe a short trade or a long trade because let's be honest, 15 minutes is a long time. I can go from the weak side to the middle to the strong side. But this is where getting paid at areas makes the most sense. This is where quick profits, getting the hell out of that trade before it has a chance to change, sets you up. And then if it's not strong or weak, it's transition, guys. And this is still a great look. I'm still only looking for long trades. But what I'm going to say is, okay, it's not the best of the best. So when I reach that first area, I might take partial profits. When I reach that first area, I might get to break even. I may manage a little more assertively because it's not the strongest look. So if you learn to recognize strong, weak transition, you already know how that trade is going to need to be managed. And then finally, the same question we ask everywhere. Is there room to targets? Do I have room to make money? Is there nothing in the way? No zones, no one-to-ones, no mid-bands, no outer bands. Can I make money if I enter this trade, guys? If the answer is no, I don't know why you would ever look. I don't know why you would ever look for an entry. No, Swathi, I just went over it. So on the large chart, so TV is different. Where price is in relationship to the triggers on the large chart helps you define the momentum of the move. Strong, weak, or transitional. On the small chart, it's the exact same lesson that you're used to. On the small chart, it's separation between the small and large. So if you see this look on your small chart, you will have large triggers over there. You know that the immediate strength is down. You know that the immediate strength is up. But because a 15-minute chart is such a slow chart, if you waited for the large triggers to do what they did on a Renko bar chart, you would be waiting for hours. Does that make sense? So we've made it easier. First it's direction, then it's momentum, and then it's path. Are you switching over to TradingView, Swathi? Are you going to get off a NinjaTrader? I'm only asking, you want to learn it also? Okay. Guys, remember, when you learn a separate platform, you're learning a whole new set of rules. So now you've got twice the things to think about. I'm not saying don't. I'm saying make sure that you can keep them separated because they're not the same. And if you confuse them, if you try to take Renko bar entries on a minute bar chart, guys, you're going to get run over a lot. Because the trend trade is the easiest trade. The trend trade is the trade that happens more often than not. And the trend trade is what's going to open your eyes to the other trades. So it starts with 15-minute not trading directly into areas. So on my large chart, I've already defined direction. I already have defined momentum and how I'm going to manage it if I find an entry. And I've already verified that I have a clear path. And that's what takes me to rule number 2. And rule number 2 really embraces and stresses the idea that a clear path is imperative, guys. Not trading into anything on the 1 minute either. No areas, no one-to-ones, no zones, no mid-bands. Rooms to target, guys. I can't stress that enough. And then rule number 3, you're going to buy or sell a pullback at a 1 minute area, at a zone, at a one-to-one or a mid-band, with a close on the weak side of the small triggers. So in the beginning, we say from the weak side, that's where reversals typically happen on a large chart. From the weak side, that's where continuation happens on a small chart. So here's your pattern. First, it's defining direction. The smalls are up. Then it's defining momentum. I'm in transition. If I get to an area, I might take partial profits, get to break even. And then it reminds me, hey, I've got room. There's nothing in the way. So then and only then, I go to my small chart. And on my small chart, everything's going up without me. And there's that fear of missing out again, guys. Once these small triggers roll, you're going to look lower. Once the small triggers point down, when the large chart's pointing up, you're going to say, I need a pullback to an area. You're going to see your areas 3, 4, 5, 7, 20 minutes before the market ever gets there. This is where trades come from. But we don't just jump in hoping that it works. So first price reaches the area. If it doesn't reach the area, the language hasn't been met. It's not a trade yet. Price reaches these yellow one-to-ones, and the entry is an up bar, a reversal bar that closes above the small triggers, on the weak side of the triggers, on the correct side of the triggers, because the weak side of the triggers is where the market typically reverses, guys. And it's one pattern. First it's direction, then it's momentum, and then it's path. Once the small triggers roll, it's a pullback to an area and an up bar that finishes on the weak side of the small triggers. So first it's down, then it's strong side, then it's room to trouble. Because the small triggers turn up when the large chart says down, I'm already calling my shots. I'm already looking higher. And when price reaches that area, I'm not just jumping in hoping that it holds because the immediate strength is against me. I'm waiting for a down bar that finishes on the weak side of the triggers because that's where continuation typically happens. So it's the exact same pattern. First, it's a pullback to close below the small triggers, and then it's heading in the direction of your trade. And guys, TradingView is different. You have to remember that it's different. You have to remember that there's subtle differences between the two, and it's easy to confuse the two if you're not paying attention. So one of the things I'm going to hand out today, whether you are NinjaTrader or whether you are TradingView. Guys, this is a sheet and it's got a checklist. So know which one you're on, use the checklist. Say to yourself, do I have strong triggers? It's got to be a yes. If it's not, I'm not going to number 2. No termination conditions on the large chart? It's got to be a yes. If it's not, I'm not looking for an entry. Guys, you're keeping yourself in check. You're policing yourself. You're going to use the same checklist to go back and write on your charts. Did I have strong triggers? Were there no terminations? Could I define an entry? And guys, the perfect trade comes from the 3 advantages. Are there any questions about anything that we've gone over this morning? Any questions about momentum, defining an entry? Guys, this is what we call a strong trending market. And somebody in crude oil really wanted that market to go down. And it happened right from Fibonacci resistance that used to be Fibonacci support. And when price reached it and all the triggers remained below, that's what set off the down. There's a look with momentum and path. Should we circle a tail? I think Pete caught that one. Well, that one went a little bit beyond the areas, didn't it? Pete might have waited for a reversal bar to confirm the move to grab hold. Good stuff. Guys, get in the habit of putting some study time in. Get in the habit of keeping it very methodical. Price reaches divergence low. I don't have a clear path. The trend is up, but I don't have momentum. Do you guys see it? This would be part of your 90%. But here I had both momentum and path. Oh, and they didn't quite get my entry. And guys, there's a pattern. There's one termination condition on a small chart. 3 divergences in the same price range may terminate a trend. 3 divergences in the same price range. Is your small chart telling you the change that you can't see on a large chart? So the large chart says down, the large chart says strong, the large chart has a clear path. Your small chart through 3 divergences says, hey, don't take that next one. It's more likely to lose. Don't take it. They're more likely to push up. And push up they did. So that's the only time I will skip that entry, when my large chart's perfect. That's your small chart termination. And guys, that's my first hour. Congratulations, you survived it. I know it's a lot like a lecture. As we get into the second hour, what we're going to do is we're going to look at the charts that have been posted, guys. The one thing that I really need you to do for me, and this is for you, it's not for me, but I tell you it's for me because some of you seem to like me. I need you to annotate your charts. I need you to write down on your charts, hey Mark, this is how I identified momentum. Because if for some reason you've made a mistake on the idea of momentum, what we're going to do is we're going to go back and we're going to say, hey, remember that momentum strength is separation, and you didn't have that separation, which means that you didn't have that first advantage. And that's okay. We'll work around it. And then you have to tell me how you felt about terminations. Because if you tell me this was a clear path when it's only the potential, well, then what we'll do is we'll go back to the core lesson of identifying a termination condition, and a little repetition creates the reinforcement that you need. And then when you enter, guys, I want you to latch onto, embrace, and love the phrase, pull back to an area inside of triggers, because you will call your shots. And when you learn this phrase, you're likely to stop taking entries from the wrong side of the triggers. And when you learn this phrase, you're less likely to take an entry right at the top. Rest of the trade for the 1 minute is on the next post. Paul, you couldn't squeeze it and get it all in one? That's a good trade. So guys, when you go through and you post in my room, describe the advantages that get you into the trade, whether it's TradingView or whether it's NinjaTrader. And here's the amazing thing that most people don't recognize, is that when it is the perfect trade, what you've done is you've written a recipe for success. You've made it repeatable because you use the idea, you said out loud, strong triggers, no terminations, pull back to an area inside of triggers. You have literally described a pattern that you can say without hesitation wins more than it loses. That's your edge. If you skip this step, if you don't annotate the chart, guys, I know what you're doing. Hell, I know what you're feeling. I've been doing this long enough. You're shorting yourself of some amazing education opportunities, guys. If you don't want to take the time to annotate your charts, you're going to get out of this software exactly what you put into it. So do me that favor. Do me that honor. You guys want to see something cool? Just say yes. Price pulled down and created a divergence that pulled all the way up. And then price retested that divergence with those weak triggers. And that's where your reversal came from. Now hold on a second. That pattern just happened in the market. I love it when this happens right at the end of the first hour, because when I say that the market moves in patterns, I want you to see something. In 2021, John Novak took a picture for the user guide, and it was a move down that created a divergence low that pushed right back up and almost hit the mid-band, retested the divergence low with weak triggers, and that's where the reversal came from. Guys, what happened in 2021 looks identical to what you guys just saw. If you focus on the patterns, not the money, you're going to find success faster. There's no doubt in my mind. Pretty crazy, right? You can predict what the market is most likely to do, but you, in that same breath, have to say, I don't know what the market's going to do, but I can identify my edge. So guys, when we come back in 5 minutes, that's what we're going to do. We're going to look at the pictures that are posted. We're going to talk about the advantages. I'm not going to play the trade police. I don't want you to play the trade police. We're going to correct things that need correcting. We're going to celebrate things worth celebrating. And guys, right now I have all the momentum I could ever hope for, and I have a brick wall of a termination condition in front of me, which means that I am not looking for a pullback to an area inside of triggers, no matter what happens next. My rules aren't met. Does that make sense? That's how your chart read will happen. First momentum, then path, then entry. 2 out of 3 is a medium probability scenario. Some of you will progress to where you take and manage. But this trade directly into a termination condition is going to lose more than it wins, which means that you don't have an edge, which means that you don't have an advantage, which means that it is 100% okay for you to sit on your hands and do nothing. Because all you need is for those small triggers to break above. All you need is the potential to break. And then look for your entry. So, good stuff. I'll be back in 5 minutes, guys. Go stretch your legs. All right, my friends, I am back. Look at that. Price reached an area. Triggers couldn't break it. Look at the big retracement. Man, that could have ruined some fun, I think. Probably opportunity in there for you guys that are a little more experienced. You said short party's over? At least for a moment, huh? There's always a fight, guys. So I'm going to scroll through up to the very top, and I'm going to click on the pictures that were posted today. And guys, I can't stress enough, I am not the trade police. I'm not going to tell you good job. Well, I might tell you good job, but I'm not going to beat you up if you made a mistake. Guys, we're just going to fix it. We're going to correct it. We're going to talk about it. We are going to hold you accountable to the plan that you told me that you're trading. And guys, this is your cordial invitation. If you are just now learning the software, you may not understand everything that we're looking at, but what you will notice, what you will see is that people are annotating. People are talking about what they're seeing. They're talking about what they're doing. They're talking about the things that are good, that are bad, whether or not their rules are met. So here's the first one. This is what I get for not waking up and just watching. Entry directly into divergence, cleared the outer band, no odds favorable momentum on the 1 minute. Very late entry using 1-to-1s as support. Let me see where you're at right here. Outside of the outer band, no momentum. Even if the stop was where the market would not go, it seems they are aware of that. They would have stopped it out. Profit targets were set halfway to 15-minute zone. Zone market should go to zone. Haha. I love that. There's that word. Minus 220. So I love it. That's a lot of talking. Large chart was up. Large chart appears to be in transition. Large chart had room. There's no doubt about it. This was your pullback. There's your area. There's your close above. But by the time you get there, you're right into an outer band, right into divergence. And you don't have all the momentum pushing it. It's just a late entry. You're absolutely right. And it comes back. And now, Paul, one of the things that I want to mention, you said even if the stop was put where the market should not go. That's a phrase that is associated with a rules-based entry. Now, here's your pullback, right? There's your close above, and you're absolutely right. That's where the market should not go. But the outer band pivot stop out, that's where the market is likely to go. So it's already been there. So this stop is completely irrelevant by the time you reach your target. Does that make sense, everybody? Just because they put a pivot in the market doesn't mean that that pivot is a solid stop placement for the rest of the day. That trade ended. And now it's off to the next trade. And then there's your next entry at an area, above. And it goes up. I hope that made sense. Victor, triggers are up, price on the weak side, space to the next area, a little. So, okay, so let's back it up. This is why we do this. So, great chart read, right? There's your pullback, there's your area, there's your close above, and then there's your target. Pivot stop out beyond the outer bands. Does that make sense? So if this trade starts here and this trade ends here, once it pulls back again, it's a whole new trade. So this stop is done because the target was reached. Now it's a whole new trade on a whole new pullback with a whole new set of circumstances and a whole new stop. This stop doesn't last until the large chart gets there. This stop is done when this trade is done, when the advantages are gone, or even when you get a new pivot higher. Does that help a little bit, Paul? Yeah, it's the perfect read. It's the perfect trade. It just didn't have anywhere to go by the time you got in. It was done. That huge bar made it difficult. If you had been in at 82, where it closed, You still only had about 2.5 points to get to that divergence high outside of the outer band. Just a tight trade. All right, Victor, weak side of the triggers. Space to the next area. All right, guys. Let's talk weak side real quick. We're still looking for long trades. If this chart, hold on. If this chart is weak, where reversals come from? If this chart is strong triggers down, do you see how the immediate momentum says we are firing south as hard as we can when this chart is showing you that it's in a position that could create a reversal? So this is one of those times, guys, where if you take a shot at it, you're fighting that immediate strength in a market that doesn't have the push up. And we're starting to see more and more of this in the room. Now, from the strong side of the triggers, I like it. But when these triggers are super strong down, those HVA lines may have a little more impact. You've got to be just a little bit more aware. But I think this is one of those lessons, and Victor, this is one of those nuances that you start to recognize a little more, and it creates just a little more patience. And if your close above, the pivot's all the way down here at 06, and you're entering at 17, you're entering 11 points away from that low pivot. That trade's in a pretty good, it's already going, and nothing's really changed on the small chart to build too much confidence about the up. And that's a nuance thing. 15-minute transition, clear. 1 minute closes below the small triggers. Missed your second profit target, came back. So, Paul, your trend trade started somewhere way up here. Do you see it? There's your pullback. There's your close below. This is where your trend trade happened. This is a good lesson, guys. The trend trade happened at the pullback to the mid-band with the close below. This is just jumping in, hoping that it's going. It's hard to call it a transition. And this was a lesson that we had yesterday, guys. The bar that you entered on is inside the zone and it's below the zone, but it never broke. This is the bar that actually broke. That was your pullback to the zone with momentum. That was your momentum style trade. So until the zone actually breaks and pulls back, you're still just sitting at the zone that could behave as support, because it goes back to that lesson. When support breaks, it becomes resistance. But if it doesn't actually break, and I think the S&P did it, if it doesn't actually break, nope, that's crude oil. It's still resistance. Does that make sense? If it doesn't actually break, it's still support. So on these minute bars, letting a full bar clear, let it get away, let it actually break, and now it's broken, right? But from here, there's just nowhere to go. But from the pullback to the zone with all the momentum, you got a shot at a momentum trade. This is where I think defining what type of trade you're in is really important. Because if it's a trend trade, you know that it's a pullback to an area inside of triggers. And so this can't be a trend trade. And if it's a momentum trade, you know that it's a breaking of the area, then a pullback to the area. So it can't be a momentum trade. So what is it? It's a jump the fudge in trade. That's it. I'm just jumping in, hoping that momentum pushes the market. From the strong side of the large chart, strong side of the triggers, with odds favorable momentum, it has a much better chance of success. From the transition point of the large triggers, you don't have that giddy up you're looking for to take a trade based just on jumping in south of an area. It's a good concept. It's great management. It's great management. HVA gamble. How is that an HVA trade, Victor? Triggers down, price on transition, space to the next trouble area. Where did you see an HVA line? Go in the opposite direction of small triggers on the large chart, went with it to the next trouble area, which set up a short trade. Next picture. Congratulations, Victor. You got lucky, brother. There is no HVA line. There is no breakout bar. Smalls are below the large. You're outside of the outer band. And I'm so glad you got paid. This trade will kick the ever-loving snot out of you more often than it doesn't if you take it as taken. You're fighting so much. Look at the momentum on the small chart. Directly into an outer band. I mean, it's a tough one. Would it help to go to screencast for? No, your annotations are great, Paul. Your annotations are great. So, Victor, and guys, this is one of the things. You start looking for more. You start messing up rules a little bit. An HVA trade is... Hold on. I don't even teach the HVA trade because it's counter trend, and that kills you guys more than it doesn't. But let me find it real quick. Trying to figure out where we have it. Hold on. Sim, live, prop, economic. Here we go. Trading view indicators. There we go. So the plan for an HVA trade, and it's right here, and I'll give you the link to it. For an HVA trade, here's your checklist. So a zone reached on the 15-minute chart. That's the first one, termination. You had that. 1 minute triggers must be above the large from lows. Didn't come close. Buy or sell a pullback to an HVA line on a 1 minute chart. Didn't have one. So you let go of two of the rules there. So first it's a termination, then the smalls get above the large, then it's a pullback to the HVA line. So that's your HVA trade. Does that make sense? You did have the termination condition. That's okay. This is part of the learning process. But this is why starting with a trend trade is typically the easiest, because if you're going HVA, you're going counter trend. You are doing your best to go counter trend, and it never really set up here. So everything was down. You were in the transition side. You had room to trouble. There's your short trade right there. But you missed it by 5 points. Because you were going counter trend. And look at those large triggers, never changed, and just all the way down, right to trouble. Just when we thought we were genius, at least grasping a rule or two. You guys are reading your large chart correctly. Victor, there is a pattern from terminations. This white bar, this breakout bar, when it's confirmed by the second bar, that's what creates the green line. It never made it. Never got there. So you took a very aggressive long from the strong side of small triggers to get to the short. But once you hit this area, you had to believe because of the large chart that closed below, that's your moneymaker taking you down. And it was, and it did great stuff. Nicely done. Aggressive long, great short. Good stuff, man. All right. Close above the zone, not strong triggers as well. Exited no momentum on the 1 minute, 15 minute up, strong side. Clear path. There's the break. There's the pullback. There's the close above, 81.75. And you just finally got tired of waiting, huh? Who was this? It's the perfect trade. Is this you, Paul? It really is. It's the perfect trade. You just got tired of waiting. Up, strong, path. There's your break. There's your pullback. There's your close above. And it just didn't go anywhere. What did it do after? Did it make it? It's hard to sit through all of this. Did it eventually make it to the zone? Of course it did. So that's okay. That's the trust side of trading. Is being able to sit through the small chart nonsense when the large chart says go. It's the perfect entry. You had it dead to rights, and it danced for a little bit. Was that this morning? That was this morning. I took a very similar trade yesterday evening, Paul, where I took the perfect entry and my stop was in the perfect spot, and I kid you not, it danced for 15 minutes. But it never got to where the market shouldn't go. And eventually it did go up. So it's hard to sit through that. I know that it's hard to sit through that. Because you start questioning everything. Strong side, room to trouble. Paul, there's your trade. And then with momentum and a pullback to the area, Jen takes the momentum style trade to get up to trouble. Jen, this is the perfect momentum trade. And I like that you put this candle fully broke through. That's the one that peaked. That's the one that broke. There's the pullback. You guys aren't going to see it on a 1 minute historically. But Jen, that's the one right there that creates the advantage. That's the one right there that sets you up. Nicely done. And you newer guys that are posting, know that I am on my way to your pictures. I am on my way to your pictures. Trend trade, triggers up, price in transition, space to the next area, manage assertively because of that. Small chart, price pulls back, closes on the correct side of the triggers. This is gorgeous. This is beautiful. Who is this? Victor, is that you? That looks like yours. Isn't that amazing? The perfect entry on the correct side of the triggers, and it goes right where it's supposed to. Nice. I took the same one. I had just woken up. I got in late and still made it to profits. But that is the perfect rules-based trade. Nicely done, Victor. You guys are giving me a highlight reel today. I like it. 15-minute up, transition, clear path. 1 minute closes above. Your zone looks a little different. I like it, though. You have room to make a little money into the zone. You hang on. You get paid. And then you exit for $200. Beautiful. And then there's your next trend trade right there. Does everybody see it? There's the first trend trade. Get paid. There's your pullback to the area. Close on the correct side. That's your second trend trade. It's hard to get right back into the market when you just got done getting paid, isn't it? Because you're like, whew, I'm done. And then it's like, no, Paul, let's make some more money. Great trading, Paul. Great trading. All right, transition. Bar closed on the correct side, but there was no room. And Jen says, you know what? From transition with no room, I choose not to take it. I support that decision. Strong top, strong triggers, clear path, and I love this. So check this out, guys. This is where language comes into play. This is where language shows up. Pete says, I'm gonna use my best Pete voice here. Pete says, I know the basic rules. I know the recipe for the perfect trade. Wow, Pete, we sound exactly alike, don't we? Let me try it again. I know the rules. I know the perfect trade is momentum, path, and entry. Dag nabbit, carn sarn it. And Pete has all the momentum, and he's got the greatest clear path ever. But Pete knows, because Pete's brilliant and very popular in a lot of social circles, Pete knows that the entry rule says areas inside of triggers. And Pete says, dang it, I'm not even reading his annotations. Pete says, I don't have any areas inside of triggers. So in my wisdom, I'm going to force the market to give me a down bar. And when it does, it lets me know that the small crowd is back in line with all of my large chart advantages. And Pete, you do it perfect. You get the reversal bar. You get the perfect price, right? You have a place to put your stop. And then it does everything you would expect a trend trade to do. And guys, why did he wait for the down bar? You greedy people are saying, if you just would have sold the mid band, dude, you would have made more money. But once you get to the wrong side of the triggers, you don't know if, when, or where that market's going to continue down. Entry language pays dividends here. Pete, this is such a great example of understanding the basic recipe and using just a little bit of patience to give yourself an edge as you get into that market when it finally does everything that the large chart says. Guys, it all goes back to momentum, path, and entry. And if you learn the language, you're going to do stuff like this too. All right. And then there was his exit. And then everything breaks. And Pete says, you know what? When the market is trending strong, when there's nothing in the way, when every indicator is down, I'm going to jump in when the large chart clears, and I'm just going to ride it down. Your trailing stop looked like it was a little late. Did that go really fast? Usually that catches you about right there. Same price, just a little different. And guys, I want you to see something again. So I'm going to make Pete today's poster child because Pete studied a lot. Pete says, in his Pete voice, these lines are where decisions are made. That's your new voice, Pete. I can't wait to meet you in person. If you actually sound like that, I'm going to lose it. So the idea for a clear path is 4 triggers through. Does everybody remember that from the very basic lesson? The idea for a clear path is 4 triggers through. Pete is taking advantage in the strong trending market. He says, well, if decisions are made at key Fibonacci areas, as they are so often, I'll allow the entire bar to get away from the decision-making point. Guys, this is a little different than rule number 2. This is a trade called the chili dog. It was developed by a Nexgen user with the understanding that decisions are made at fibs. And once it gets below with all of this good stuff, he just jumps the fudge in. And because he knows that the only thing he has going for him is really momentum and nothing in the way, there is no defined entry, he takes quick profits, and when momentum goes away, he exits the trade. I love everything about this trade, Pete. But it's based, again, from that very core, that very basic remedial 101 talked about every day. Decisions are made right at those key Fibonacci areas. Outstanding trading this morning. All right, let's see what we have. 15-minute down, strong side, clear path, 1-minute close below small triggers and into the zone. It wasn't there until entry. Did take into consideration the one-to-ones. Where are the one-to-ones? There they are over here. Price closed below that. Stop was above the last pivot where the market shouldn't go. Just if it wasn't there, you didn't see it, right? And that happens sometimes. So if you take a trade and that wasn't there, it's the perfect trade. And if it shows up, it's okay to exit that trade. Great trade though, Paul. It makes sense. You did everything the rules said it was supposed to do. That zone just popped in and ruined your good time. And it made it difficult to take the re-entry. That's just one of those Murphy's Law, right? Weak top, strong triggers, Get below trouble, jump in with momentum, make some money, profit stop, commission saver, re-entered, make money. Nicely done, Pete. Once again, momentum and path. Yeah, every now and then Murphy rears his ugly head, doesn't he? Zone reached on the 15-minute chart. Oh, this was the HVA trade. We opened that together, huh? Right on. Okay, we made it through the first round of pictures. Good job, everybody. And now, let's see. Pete, was that one you? All right, now here's my favorite part of class. Are you guys ready? Whoop, we got one more here. Is I'm about to jump on the new kids charts, which I love. Oh, there's all the momentum. Get below trouble. The bar didn't quite clear it. It goes up a little bit, and then you make your money. Nicely done. All right, Orlando. I'm excited about this. So this is a large chart. Absolutely. Let's see what we have going on. 3 triggers have gone through the fib line. However, a 1-to-1 is coming up. I like this picture, Orlando. I'm going to do it like this. So large chart read. You're learning the language, right? So I'm going to highlight the lines on the chart that qualify as termination conditions. Let me change the color here. We'll make them yellow. Are you with me in here, Orlando? So the recipe, and you're paying attention, and you definitely see it, which I love. The recipe is price reaches. Where are triggers, right? Let's count triggers. So you're looking at the fib at 84, and when the market is right here, you're saying, awesome, 3 triggers are through. Am I in your head okay there? And you see that fib, and you're like, man, look at that fib, 3 triggers through, hell yeah. Heck yeah, because Orlando, you're not going to say the latter. But do you see that divergence high? That's that next line. And none of the triggers are through that one. Well, one of the triggers are through, which means that's a termination condition. So even though we've got 3 above the fib, we've reached that next area that says no more longs. And then the 1-to-1s, as long as price doesn't touch them and you find an entry, that's a target. Until price reaches, anything in the distance is a target. Does that make sense, Orlando? So this is pretty common for the new user. And I would say it's probably pretty common for the experienced user too. And here it is right here. I got 3 triggers above the fib, and I'm really excited. And I'm so focused on this fib and its potential to break that I forget to notice that it reached the pink 1-to-1s. And notice that only 2 trigger lines made it through. And I think you had 1-to-1s where I have this fib, and then it gets to the fib. So when we present in the morning, when I present in the morning, one of the things that I mention when we talk about termination conditions is that there will be times when you have those kind of stacked areas, and you just may not get the path that you need. But let's go back and celebrate victories, because I think victories, especially for new users, are important to celebrate. Did you see the momentum on the chart? Did you see the separation between the small and large? Did you say to yourself, hey, these are strong triggers, let's go look for termination conditions? Because if you did, that's awesome. That's day 3, and you've already got rule number 1 nailed. That's pretty cool. You're 2/3 of the way. So now we go into that lesson, right? And if you didn't post this picture, Orlando, how could we ever have that discussion that reminds you to always look at which line was hit the most recently? But your read is perfect. 3 triggers through, potential to break. We just have to throw that divergence high into the mix too. Does all that make sense? I love it. I love it. And you're going to get that point where it's going to look like this. And that's a good example. Price reaches that divergence low and you're like, "Ah, no trades." And then I finally get the small triggers, 3 triggers through, and dang it, there's a fib. And I finally get 3 triggers through, and dang it, there's another fib. And then finally, it all breaks. And this is really common. And Fibonacci is so stinking effective because your fibs are based on all the stuff that's already happened. They know about the areas long before they get to them. Look at that, where it peaked out right here and had a pivot stop out. That's exactly where they died the next time. So by knowing that history, it sets you up. There's another one of those examples where we've got to look at trigger lines versus all 3 areas. Thank you for posting in the room. That's awesome. That's hard to do when you're brand new. I know that's hard to do when you're brand new. I hope I was easy on you. You call your wife, "Man, Mark's a jerk. I hate Nexgen. He told me I was wrong." Weak top, strong top. They're both strong tops, Pete, as soon as it reverses. No triggers through termination, backed up with a no triggers through termination. I agree 100%. I try to wear velvet gloves. Odds favorable, 50-50. Pete knows that it's the potential to break. No divergence, perfect entry, quick profits. Divergence is a loss of momentum, which means that it's starting to eat into his first advantage, and Pete takes the exit. Beautiful trade. That's how you manage a 50-50. Take the perfect entry with the potential to break. If your small chart shows you change, it's okay to exit and wait for the next one. Really great management on that one. All right, Justin Ryan. Let's see what you're doing, my friend. All right, pull back to the zone, right inside of triggers. I like it. Partial lessons here. Are you with me, Justin? Cool. And I do this for new users, guys, because it's important that you're always thinking about it. Pull back. Does that say to the bone zone? Pull back to the area inside of triggers, right? Pull back to the area inside of triggers. That's the perfect entry. It's beautiful. You are missing your synthetic triggers. I'm going to get you fixed on that. But I want to go back to the large chart advantages. The small triggers are above the large triggers in an uptrend. You don't have momentum. Does that make sense? I'm not saying there's anything wrong with it, and I want to go back and look and see where it's coming from because that may be the perfect trade. But you don't have the beginner's version of strong triggers. Cool. And here, price reached Fibonacci support and all the triggers are above. And you don't have a clear path. The only thing that you really had working for you here was the perfect entry that provided low risk. Does that make sense? You were in a low probability trade. But because you get in, and you got in a little late at an area inside of triggers, it was low risk. And if something changed, you would just say, "Hey, it's not the perfect trade. I may need to manage." Does that make sense, Justin? I'm not busting you up for breaking 2 rules. I'm saying that's a hell of a good entry. And the one thing that I want you to take from this is that if you just say out loud at your computer screen, "This isn't perfect, I may have to manage," you know that there may be a management opportunity there. And it didn't even offer one. Was that this morning in the S&P? That was, hold on, I'm going to find a picture of it. So this was it right here. So can I show you something completely pattern-based that made your trade even better? I want you to see something. And you probably didn't realize that you were this smart. Not yet, but I'm going to remind you that you are. So there's this concept, dun, 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 and this is a pattern, guys, and this is a pattern that really pays dividends when you learn it, and it's called a strong top or a strong bottom. So everybody in the room, when you get a termination condition that reverses the market, that's a strong top. That's when the market is more likely to continue in the other direction because the decisions made by the large crowd were so impactful that the sellers not only shut down the buyers, but completely reversed the market. So strong tops and strong bottoms are termination conditions, no triggers through, that reverse the market. So here's a pattern. Do you see how that is not a termination condition? That's what we call a weak bottom. Never did squats. So because this is weak, Justin, price pushes up and it hits that mid band. Okay? The mid band is a termination condition if the large triggers remain a full bar away. We call this the gap theory. And on your spreadsheet, there's about 50 examples of it. So the gap theory, it simply says your mid band is a termination condition if it's reached and the large triggers are a full bar away. Now from a weak top or bottom, that mid band is more likely to hold. So what you had was a termination condition and the market reversed. You actually had a strong top in place. You probably didn't realize it at the moment. Now I want to show you something else, and this is where the brilliance comes in. And I don't know if you've got a voodoo doll or what, but let me show you a trade. Whoops, that's not it. That Nexgen started teaching in 2004 and 2005. If you have a termination condition, if the small triggers roll, sell the pullback to the small triggers. This is Nexgen's original edge trade, Justin, from 20 years ago. You nailed it like you've been studying that pattern your whole life. I mean, perfect. Your entry happened to be the perfect entry from 2004. Termination, smalls roll, sell the pullback. It gives you room back to trouble. Does that all make sense? So I think you may have gotten lucky from a new user standpoint, but there were so many advantages in play on this trade. So many advantages in play on this trade, it looks brilliant with a little bit of chart reading. If the termination reverses the market, it's more likely to go down than up. If the small triggers roll, you're on the strong side, the best momentum ever. And if price pulls back to those small triggers, Nexgen's been teaching this one for 21 years. Great job. Does all that make sense? Some of it may not. But one of the things that happens, guys, is when you post in the room, we'll talk about all sorts of good stuff. I also want to point out that you got paid at large chart trouble, which is brilliant. And then you got paid at small chart trouble, which is brilliant. And this whole trade from 84 to 79 to 76. So 8, 5, 13 times 50, $600 trade, Justin. Hey, Peter K., welcome to the room. That's a $600 trade based on 20-year-old methodology. I love it. And Estefania, you hate the gap theory. You love the gap theory. You just hated the hard lessons to figuring it out. You're good at it now. I've seen you. Let's see what Estefania did. Estefania says, with all of this momentum, with the potential to break, I'll just jump the fudge in. Low tick. Estefania, that's not easy to do. And here's a great lesson, guys. If you decide to just jump the fudge in, and that's exactly what Estefania did. She said, everything is screaming south. I'm going to jump in and hope that it screams south. Hey, killer. Relax. You guys made Ellie mad. When the large chart is perfect and beautiful and amazing, this failure of the momentum trade typically turns into a trend trade. But Estefania, I see an entry here, and I also see an entry here. So did you add on to your position on the way up? But it pulled right back to a mid-band, right back to one-to-ones, right inside of triggers, and then you ride it down. It's a great trade. If you're going to take this trade, it's awesome. That reversal bar is your loss of momentum. Your second entry is a beautiful exit when this trade fails, because you can say it's probably going up here. And that is from, I don't know, where are you in, 74.50? That's $100. That's an extra $100 worth of risk. That's an extra $100 less that you're going to make if this one fails. Nicely done, though. And you said you got excited when it didn't even finish building the space. I think we've all done it. I've got a rule in my life, Estefania, and some people do it, some people don't. I won't pull the trigger until I've had a cup of coffee. I won't pull, and not because I need the caffeine to wake up, but because it forces me to sit still for 15 minutes, to look at my indicators, to not get excited about, oh my gosh, was this a move? I got to jump in. Because I lose more of those than I win. That's my own personal rule, guys, and you may have your own personal rule. Weak triggers, but strong trend. Who is this? This is Estefania. I love it. Chili dog it. When everything is down, when there's nothing in the way, jump the fudge in and make some money. Nicely done, Estefania. What a great trade. That's the okay, I'm awake now trade. Beautiful. Beautiful, beautiful, beautiful. You guys make me so proud. You're all so good at this. Does everyone remember when you didn't understand momentum? Do you guys remember when it seemed like there was never going to be a trade? I remember. I remember watching people in the room make money, and I was a brand new user. For those of you that don't know, I was a brand new user 6 years ago. I'd seen the software because it's my brother, but never studied it, didn't have rules, didn't know anything, started at ground zero. And I used to sit in the room and watch people make money and just felt left out. I felt like I was never going to make money and they're making all the money and I suck and I hate it and I'm so angry. And then one day I woke up with a little bit of study and I'm finding the exact same trades. Know that you're headed there, guys. Know that you're headed there. All right, let's see what you did, Paul. Jump the fudge in rules. I don't have any. Jump the fudge in exit. At trouble. That seems good. Price was off screen. Had both charts stretched out to pick up action easier. So when it rippled, the price was on the floor somewhere. I exited just because such momentum will flip around and be coming for you. I saw the money made. Good enough. Pulled the plug. 23.50. So everything is down and strong from a termination. And you just jump in. You say, you know what? I'm going down with it. You get in just below the zone with momentum from the strong side, and it just cranks. Do I have rules for it? No. But Paul, let's ask the other question. Did you have every advantage? Yes. You're coming from a termination. The small triggers are pointed down. You're on the strong side of the small triggers. You have odds favorable momentum and you entered below trouble. Holy crap. That is a jump the fudge in trade if ever I've seen one. But when it's rooted in so many advantages, 23.50 is not a bad run, right? And you could have exited right here and it's still a beautiful trade. But look at the momentum. And look at the momentum. And they didn't make the last one on you, right? I love it. It's got to give up eventually. Momentum dies eventually. You don't know when. Estefania didn't know when, so she got paid, right? Pete never knows when, so Pete gets paid. Guys, when you're just jumping the fudge in, get paid. GTFO. You pulled one over on the market. Nicely done, Paul. I like that. Rooted in advantages. There it is again. Get in, make money, get out, pulls all the way back, hits resistance that used to be support. Large triggers don't follow. Pete does nothing for a little bit, and then once everything agrees, jumps in and gets paid again. Great trade. Great trade. And there's that concept again, when price comes up and smacks something, those large triggers don't follow. Regression of the mean. And Pete says, well, let me get below that thing that could stop it. Short partiers wanted to keep on partying. Amen. Good stuff, guys. That's all the pictures. Nice. Well, it was till Victor posted. Way to go, Victor. Just kidding. Let's see what happened. Trend trade. Triggers down. Price on the weak side. Manage this baby aggressively. Nothing but clear skies. Small chart. Triggers roll. Price closes, pulls all the way up. There's your close below at 85. You've got 14 points to get to trouble. I like it. Tons of room to make some money. And you get out at 74. So you didn't get paid at trouble from the weak side. You let it bounce and said, oh, shnikes, I'll get out at 74. Or you just made your 200. And then the second one, you're like, let's see if it goes. I like it. 65.25. Right at the bottom of the zone. Great trade, Victor. Great entries. Make very manageable trades, guys. Oh, hold on. Small chart triggers roll. Price on the set your profit target. Stop loss first. Hit profit target. Thought I calculated correctly for second, but did not. Missed it by $10. Ah, there you go. Second profit target hit. Ended up with 635. The purchasing power at the bottom right of the screen. So darn close. What does that mean? The purchasing power at the bottom right of the screen. Hold on. There it is. What do you need to pass? 550? You're so close. You're almost there. Don't worry about that. That'll happen, right? Keep taking the right trades. Don't focus on the money. Focus on the process that gets you there. But guys, this is everything. This is the trade. So I'm going to ask anyone in the room that's been through the roller coaster, and most of you know what I'm going to ask. Do I need more trades? Do I need HVAs? Do I need momentum? Do I need jump the fudge in to hit my goals daily? And I'm asking this, you don't have to answer in the room. Guys, what I have found is that the more you look for, the less you find. The more trades you try to take, the more chances you try to take, the more opportunities you try to fabricate, the more you struggle. And I think, Victor, you've proven that on only trend trades, you can fund an account. You can make consistent money. So when do accounts go sideways? When we start using language like it should. When you start using language like it will. When you start using language like I hope. Your thought was with that trade, we were on the weak side of the 15. We did not have momentum down 1 minute. I balked. That's okay. So let's go back to it. Thank you for sharing that. So I want to do this. Victor, I'm going to take your awesome trade, and what I'm going to do is I am going to cover yours with mine. So the large chart read is down, right? And the large chart's on the weak side. So guys, what does that mean? That means I need to be aware of 1 minute areas that can stop. So it sets management in place, but I'm still looking for short trades. And I've got room to targets. Go look for an entry. And I know what you were thinking. So Jen, you were thinking, hold on, there we go. That looks like a lot of strength from the weak side. And you chose not to take it, right? And guys, one of the things that happens Um, this happens to me after a couple losing days. I start overthinking a little bit. But let's look at this. From the point of entry, Jen, where did it pull back to on the large chart? Pulled right back to the zone, right? And you're not going up with triggers down. But look at this. It couldn't get above. It couldn't get above. It couldn't get above. Couldn't get above. Couldn't get above. Couldn't get past the mid band. And then when you finally get the close below, your immediate strength indicator, those small triggers, they're pointing down. And by the time that bar closed, they were decidedly down. So you're not fighting the immediate strength. These large triggers will mind mess you a little bit. Now right here, well, they're not even wide. If they look like this, those super strongs, I get it. But by the time the entry comes, that area, it slid sideways for 5 minutes and couldn't progress forward. And then it closes below. I like that trade. And then, does that make sense? And then for me, it's 2 contracts out at 72 because of the weak side. So 13 points, 260, that becomes a $520 trade for me. And I'm out 100%. The second it hits, I don't care what happens next because I'm on the weak side of the triggers. And I think that I'll share something funny with you guys because everybody is cyclical, guys. We go through these roller coasters where we are amazing. They open at 5 p.m. for trading, Swathi. If they're not open, you don't trade. But they do open. So like, I think it's 5 or 6 Central. You'll start to see movement. 5 Central, there you go. So on Sunday after 5 Central, but the volume's a little low. So be aware. I'm going to show you, Jen, because I like to share these things that I've gone through. Oh, every day, twice on Sunday. Oh, I get it. It's an idiom. Swathi, I didn't realize what you were responding to. Every day, twice on Sunday is just a way of saying that it's so great, I will do it every chance I get. Yeah, it's an American saying. That took me a second. No, don't be sorry. I didn't catch it either. So guys, we start going through these things. When the large chart says that it's time to take a trade, right? And you know that this is where your trade comes from. If you are focused on the money and afraid it's going to go without you, you typically jump in somewhere up here. And if you don't trust your entries, you're likely to jump in if you feel like the market's running without you. And then eventually, guys, we all get to this point with some study where we do take the perfect entry. And I think most of us get to this spot pretty easy. And then you've got to go through management. And I want to show you guys what I did. I got to the point where I would take the perfect entry. And the market would get $30 or $40 away from my perfect entry. And I would go to break even because I was terrified and I didn't trust and I didn't want to lose. And guys, I got into this horrible habit where I would overthink so much. I would take 20 trades in a day. I would make 1 to 2 ticks per trade. I'm not proud of this. And I would be down $200 in commissions. I would overtrade. I would get in, I'd get out, I'd overtrade, I'd go back and forth. And guys, you're going to have to go through the whole process. First, you're going to learn your entries, and you've got to trust your entries. And you've got to trust them to where you behave without hesitation, to where you're like, it is what it is, I have to take it, that's my goal. And then you get to the point to where you learn to manage that great entry. So I want to read this, and this is kind of a takeoff. John wrote this in 2008. In 2008, he said, Nexgen will supply the Fibonacci-based software trading rules along with the coaching that will increase your odds of winning more than losing. That's what we talk about every morning for an entire hour. That's what we're here for. After choosing Nexgen to be your technical analysis partner, do not worry about how long it'll take you to become a profitable trader. Worry about the process of learning. This is straight out of Mark Douglas, guys. And if you've never watched Mark Douglas, do yourself a favor. He's an amazing, well, rest in peace. He's no longer with us, but he was the guru. He was the leading voice in trade psychology and probabilities. And he and John Novak worked together extensively. And if you watch Mark Douglas, you'll notice that a lot of the language in this room is derived from that exactly. Learn the process. Don't worry about the money. And remember that simulation of your trading plan is not trading. It's practicing the movements of trading until they're so ingrained in your muscle memory that you no longer have to think about trading your plan consciously. This will be your first goal, learning the rules, knowing what it looks like, pulling the trigger. Your second goal, this is where we all fall short, is to simulate 25 of the same trade setups. 25 of the exact same pattern, trend trades, continuation, whatever, but following your plan without deviation, distracting thoughts, or hesitation to act. Hesitation is what happens when you don't trust the plan. You don't trust the plan on the first 10. You start to trust it on the next 10, and hopefully by the end of 25, you no longer hesitate. You enter because the rules are true, because it provides an edge. That is a journey, guys. It takes a minute to get to that spot. Writing down, using screencast picture, labeling your charts, what you should have done better, and then getting feedback from the Nexgen staff. What John is describing in 2008 is 100% what I told you guys today is going to get you where you want to be the fastest. Annotate your charts and talk about what you see. And I know it feels like a colossal pain in the ass. I have to do work to be rich? That's ridiculous. But guys, everyone's different. And it takes time to be unconsciously consistent. My rules are met, I'll enter. That's it. I don't even have to think about it. I see my rules in a fraction of a second, I'm in. The more times you complete 25 of the exact same trades on simulation, posting charts for feedback in the room, and following your plan, here we go again, without deviation, distracting thoughts, or hesitation to act, the closer you will be to becoming a profitable trader. You will not have to win all 25 trades. If you win 15 and you lose 10, you should still be a winning trader if you manage the trades correctly. Each time you repeat the 25 trades and successfully win overall, you then take the chance to trade real money, making sure you can follow your plan, here we go again, without deviation, distracting thoughts, or hesitation. Why do we hesitate? Because we don't trust. Why do we hesitate? Because we're worried about losing. Guys, you have to learn that you'll never know. And when you trade real money, if you fail, and all of us failed with real money in the beginning. I don't care who you are. I've never met anybody that went out of the blocks and was a successful trader from the get-go. But when you fail to follow your plan and you end up losing money, you're not a professional profitable trader yet. Don't despair. Don't do too much financial damage. Guys, that is where, and what a great segue. I don't think John had no idea he would even have this company when he started. You can test your plan on a prop firm. You can control $50,000 for $87. You don't have to blow $5,000 like I did. And if it doesn't work out, if you don't pass, you have two options, guys. You can continue the path of failure, hoping that you magically get better just by showing up, or you can go back to simulator and get regrounded in the roots and take a couple days. And traders feel like going back to simulator is a failure. It's not. I've gone back 100 times. Most traders will return to simulator several times. This is expected, very common. You are not losing, you are learning. There is a difference. So becoming great at any profession has a cost. Your cost will be small losing runs with live money. This is why prop firms are a good way to test your plan. And finally, you will learn to follow your plan and make money most of the time. Then you can call yourself a professional trader. Typically, after most traders achieve the successful mindset and the ability to no longer have to think about trading the rules consciously, they never lose it. Nexgen provides analysis, rules, coaching. Only you will be responsible for becoming the profitable trader. What's the timeline? I don't know. Most people understand what we do within 30 days. Most people take 30 to 90 days to practice it, to get good at it. And most people return to the simulator a couple times. I had a question the other day. Do you think I could be profitable within 2 to 3 days? Guys, I will never lie to you. It doesn't serve me. I will never lie to you. I don't think really anybody could be profitable in 2 to 3 days. There's a few moving parts that you got to figure out. Entries are only a small part of it. You've got to get to the point to where you say, if I take this pullback to the area inside of triggers, I have to know what I'm going to do with the rest of the moves. So I wanted to share that. I'm going to get into my second break. Boaz, we'll start with your picture next. But I'm saying that because, guys, it's okay. You're on a journey. Let me help. You're going to make mistakes. Let me help. You're going to have questions. Let me help. This room is 100% a discussion. Take advantage of it. And if you hesitate, then you don't trust completely. You're focused on something outside of the rules being met, and that's okay. That's normal. That's a part of it. But acknowledge when you go back and talk yourself out of a trade, go back and write your rules down on that chart. And what you'll find is very often your guts will keep you out of the perfect trade, and your emotions will put you into some pretty crappy trades. So that's where that consistency comes in. Man, that was a little bit of a soapbox. So I'm going to go away for 5 minutes. We got about 35 more minutes. Boaz, we're going to start with you. I feel like I have an idea. I know what happened here. Momentum. Nothing in the way on the first one. Pull back to the area inside the triggers. Perfect trade. Down it goes. Amazing hold with all of that momentum. If it pulls back, it's likely to become a trend trade. That's exactly what it did. And down it goes. Outstanding trade, Boaz. Starts with momentum and path. And then your trigger line said, don't sweat it. Let's make more money. Outstanding. All right, Z-Robot. This is a very basic, simple view. What am I overlooking? Is this a medium probability trend trade? My displays drawings are my internal documentation format. I have 1,000 of detailed trading drawings. All right. Let's see. So 2B, hard bottom. Question B. So if a B is a hard bottom, why would we be pointing at the top, Z-Robot? Can I simplify it a little bit? Is that cool? You all right with it? And we won't even go to the small chart. And I know that your brain works different than mine. And that's okay. But if a trade is first momentum in a clear path, separation between the small and large is momentum, right? Can we agree that your momentum is good, life is good, this is odds favorable? You guys feel good about it? Awesome. So, and this is exactly what it is, Z-Robot. So price reaches the divergence high and the triggers don't break. So what that means is that you've reached a termination condition. And because it's a termination condition, the rules say no trades into terms. Now you have to decide whether or not you actually want to do it. The divergence highs and lows are one of the biggest forgotten termination conditions. It's funny, and I don't know why that is. So I made this about 2.5 years ago. Termination conditions are Fibonacci-based indicators that may reverse the market based on a comparison of the area and the triggers. And everybody remembers blue Fibonacci support, and nobody forgets about red Fibonacci resistance. Even the yellow one-to-ones tend to jump off at the screen for people. Divergence highs and lows made the list, and I kind of put a little why. So anytime the market has a divergence high or low, it is a specific point, an exact point, where not only could the in control force, buyers pushing up, sellers pushing down, not push any further in their direction, but they also lost momentum there. And it's like a line in the sand. And very often, they will try to, so the buyers will push up and create divergence, and the buyers will try to break it again. And that line in the sand is a representation of exactly where the sellers are likely to unload, where the sellers are likely to 100% shut them down and tell them, no more, we've already told you once. And you see it, this is the perfect example. And I think we even looked at this one earlier today. So the sellers are in control and life is good and they're pushing down and everything is amazing. And the buyers say, you know what, sellers? Nope. We want to take a shove. And that's what creates the divergence low. The sellers say, yeah, buyers, we really wanted to go down. And when they reach that line in the sand, you can see that the buyers said, we'll give you a tick or two, make you think you had it, but then we're going to unleash. So these divergence highs and lows become these exact points where fights can happen. Sometimes they push through a little bit, but very often, and there's a great example, that divergence low holds a couple times. That divergence high holds, that divergence high holds. So That's a lot of words, right? To go back and talk about it. So while you did have all the momentum you could ever hope for, what you didn't have was a clear path. Does that make sense? So we're 2 out of 3. Let me go to the next step on this one because I'm not done yet. You guys know me. I like to talk. Let me get the picture in here. Is this all making sense? So I know I have momentum because of strong triggers. And now you can say, Z-Robot, I don't have a clear path. It's a term. Rule 100% not met, not even potential. So it's not a medium. And now I'm going to say, do I have an area inside of triggers? Well, you get in a couple ticks above the area inside of triggers. Your entry area is perfect. So you've got 2 out of 3. So when I have 2 of 3 advantages, I have to manage assertively. That's it. So you take the great trade, it starts up, you get paid, and you GTFO, right? That's fear. That's fear of something changing. I know that because there's no reason to exit. Everything's going great. And these little ticks are just going to, that $13, well, that's $130 on a big contract. That's okay. Those adds up. But let's talk about the idea, just get into management a little bit because there was a great example. Do you see the divergence right there, that lower divergence? That's a loss of momentum. That's your change that if you're going to take this trade, you've got to pay attention to. And honestly, the divergence before it would have been a red flag as well. But when you go back to those very basic concepts, right? Momentum path entry, you had 2 out of 3. You took the trade, you managed assertively. I can't find a thing wrong with it. But I want to make sure that you know that was a termination. And I like that you asked, right? And since it is a termination, the room is gone. You've already reached the brick wall. You've already, oh my gosh, it's great. And then down here where you took the short, perfect. And the second higher divergence was your exit condition, small chart exit condition. Once again, perfect entry, terrified exit, but you're working through it, right? The second divergence is your opportunity to exit. Don't be afraid to show me everything. This is the perfect trade that failed. Small chart gave you the heads up. This was the not perfect trade that had to be managed a little more assertively. Great stuff. Good questions. Guys, I'm telling you, what happens is the more you post in my room, price reaches the mid band, large triggers are below the reversal bar marker, price is likely to close that gap to the triggers. Not guaranteed, but it's more likely. The more you post in my room, guys, everybody can get a step closer every day. All you have to do is have the courage to post. And after a couple postings, you start saying things like, man, Mark's not that bad of a guy. I don't know why people complain about him. All the momentum, room to the fib, no areas inside of triggers. Do you see it again, guys? 2 out of 3. Momentum and path. I can't define an entry. How do I know if the market's gonna run up to the fib, right? Is it gonna make it up to that fib? Is it gonna go up to the mid band? Hell, I don't know. What can I do? Well, if I really want to take this trade, I can enter on a reversal bar because now the small crowd's going in the same direction as the large crowd. And because I know it's 2 out of 3, I can manage assertively if something changes. Does that make sense? Z-Robot, this is the exact same thing that you had, but this time, instead of not a clear path, we couldn't define the entry. So you're always leaning on those 3 concepts, guys. And if you do that every time, if every time you think it's time to take a trade, instead of saying, I wonder how much money I'm going to make, I hope I don't lose, you say, I have momentum, I have a clear path, I can't define an entry area. And how do I know I can't define it? Because I have to sell a pullback. Here comes language again. At an area inside of triggers. And guys, if you skip one of these, you butcher the equation. So I do have an area. It's not inside of triggers. This is where you can exercise your right to demand that the market give you a reversal bar before you ever consider to enter. And if something changes before your targets, you know that you have to manage. Everything that I teach in this room, guys, everything that you guys do in some form or fashion will go back to momentum, path, and entry. And if you entered on the reversal bar, you're feeling pretty good right now. Making some money. What would you guys like to talk about? I've been flapping my gums forever. What does my large chart say? My large chart says down with the potential for up, right? Because those triggers are trying to roll up. If it goes back down, they'll be down. But if it goes up, they'll be up. So let's look at what the small chart says. The small chart says there's my pullback, right to the zone, right to the area. And if I got to close below, I could take a shot. It happened here, but it didn't go. And now it's back up. And guys, in 2 minutes and 10 seconds, I'll know whether or not those small triggers rolled. Maybe I want to wait for that, right? Because if these roll, I'm on the strong side with room. It didn't close. I might be looking for a momentum trade. Does that make sense? That's your large chart read. The small chart says you don't have an entry. The large chart says we might reverse. That's what we do from the weak side. So now you're in this little, all right, let's see what happens. If I get a close below the small triggers right now, I could take that trade. I could manage it assertively because it's weak side and they're not up yet. Until they pinch, roll, spread, those are down triggers. You guys want to just watch it, see what happens? We've got 10 seconds on the small chart. I am not getting a close below in the next 6 seconds. 4, 3, 2, 1. All right. I've got a minute over here, but look at them. Everything is pointing up. Everything is pointing up. I don't care how much space I have down, guys. I don't have an edge. I don't have an advantage. Well, Mark, why didn't you go long? Because these were pointed down. And my life revolves around simplicity. And every time I fight these triggers, I lose more than I win, guys. You may have similar results. You may have different results. I think I took a picture yesterday where the large chart small triggers were just up all day. And if you fought them, you lost all day. I don't know where that picture went. I take a lot of pictures. Nope, I don't know. As long as these have been down, the market's been down. When there's a huge run up, even from the weak side, the market goes up. Reversals tend to happen from the weak side of the triggers. Weak side of the triggers, market continues up. Once you believe it, it makes life easier. Once you believe it. Now they're up, guys, but I got nowhere to go. I'm in a holding pattern. Does that make sense? I'm just in a holding pattern. It's not my best look. I don't even need to look at it. Crude oil is just cranking to the downside. S&P has 2 triggers through this area. Oop, price reached the next area. I got a termination. But look at this. Mid-band's not a termination because the large triggers aren't a full bar away. There's your pullback to areas inside of triggers. 2 triggers through. All the momentum. There's your pullback to an area inside of triggers. Do you guys see the difference? This one had 2 triggers through. This one didn't. That's why the large chart leads the way. Because your large chart shows the big picture. Now it's 2 triggers through, right? If we got a pullback right now, can we define before it ever happens areas inside of triggers? That's it. And guys, a pullback needs a reversal bar, which means the reversal bar would be below this area. That area is out of the equation. I've got one tiny little circle where if this market's going to continue up, that's it. That's my spot. Doesn't guarantee a winner. Doesn't mean that they'll even pull back, but now I got 3 triggers through. I still have momentum. I still have areas inside of triggers. And it just keeps going, right? And now, if I get a reversal bar, that's my highest point. That's a good momentum look. All I'm doing is going through my checklist in my head. If then, if I get this, then I need that. If I see this, then I want that. If it does this, then I'll do that. Guys, my opinion sucks. My opinion is absolutely no good. Some people say, all right, there's my highest point of support, but it could push lower. Hell, maybe I'll just add on if it does. Maybe I'll take one from the top and one from the bottom. Pete does this expertly. Pete even says, you know what? I'll just jump in if they decide to run. And if they don't decide to run, I've got 2 spots where they're likely to pull back. Does that make sense? He thinks like 6 steps ahead. It's like a chess master. If this fails, well then it's probably going to pull back to the area inside of triggers. If that happens, my stop belongs where the market shouldn't. And if this one pushes lower, I've still got another backstop. We're just having fun, guys. Divergence is the biggest killer of this trade. You have to make the choice on whether or not you want to take it. I'm not calling trades. This is informational, guys. If you just jump in, where does the failure take you? If this one doesn't hold, where's the next spot to hold? If that one doesn't hold, where shouldn't the market go? Does that make sense? I can talk through all of this because I know my rules. I don't have any idea what plan I have on here. Looks like it's just going to take all 4 off. If I get a reversal bar in the direction of my trade, I can reduce my risk below the reversal bar. If it pushes down to the areas inside of triggers, whoops. I don't know what happened there. That's where the market shouldn't go. I don't know how we ended up in 6 contracts, but we did. And divergence is the biggest killer of the 50-50 trade, right? Divergence is the biggest killer of the 50-50 trade. If you took this trade hoping to win, you did not trade a pattern that optimizes your chances of success. You didn't recognize that it was from a weak bottom. You didn't recognize that it was only 2 triggers. You didn't recognize that divergence printed. Guys, on the plan that I give you, those are 3 red flags that say absolutely no trade. Now, it doesn't mean that it's going to lose, doesn't mean that it's going to win. It means that this is not your best look. And a second lower divergence should send us crashing down even lower. You guys just want to leave it on, lose $1,300 breaking rules? And even more importantly, if you missed it the 3 times that I put it in the room, this is an educational room, guys. I don't call trades and I don't tell you when to enter the market. I talk about patterns. That's it. You guys just want to let it ride out? I hope it kills it. I hope we lose. I hope we lose every penny the market had to give. Why? Because we broke rules. Because I don't have an edge. This isn't my best look. But it did pull back to support, and all the triggers were above it, and it did pull back to support, and all the triggers are above it, right? And the only thing that really worries me now would be a lower divergence. A lower divergence would be the beginning of the end. And if it never prints, guess what? We're still in the trade. Oh, I don't have any profit targets set up. What do you say? Since it is medium probability, we'll take most of it off there. And then we will take the rest off if they decide to get to the fib. We had our reversal bar, right? Management says a second lower divergence is a reason for exit. So I'll put my stop where I'll know whether or not divergence is true. I've got my first target at a potential trouble spot. If divergence prints 1, 2 ticks below, I'll exit my position. If it doesn't print, I won't worry about it. That means we're still going up. There we go. First target is reached. Don't need a limit order up there. Divergence would still be an exit position. I'm going to hold my position. If they make it to the fib, guess what? Good stuff. If they don't make it to the fib, who cares? I've already been paid. 3 triggers through, 1 divergence. I know I have to manage assertively. If it goes outstanding, if it doesn't, no worries. I've already been paid. Oh, I'm long 2. Why is that a buy? My stop should be 2. My target should be 2. There we go. Now we're in. And if I get a second divergence, I'm not worried about it because now I have a clear path. So I have to make a choice. Do I want to keep it where the market shouldn't go? Do I want to exit with divergence and look for a re-entry? I'll just go break even. I'll go break even. We'll see what happens. Because with this look, if I get a pullback to an area inside of triggers, it's just a medium probability trade again because I don't have momentum. This is my line in the sand. If it doesn't go up right here, they're probably going to stop me out. Let's see what happens. This is exciting. If we get a reversal bar up, new pivot, new stop. If we don't get a reversal bar up, we might get stopped out of this one for 25 bucks. Does everything I'm doing make sense? First, I decide what kind of trade I'm getting into. We did these crazy entries to show that there's a lot of different options that you guys take, but ultimately, stops have to go where the market shouldn't, right? If I jump up here, 12 ticks doesn't keep me safe. It's not where the market shouldn't go. If I get in at the highest point, it doesn't mean that my stop goes at the lowest point. That's not where the market shouldn't go. If I get in at the lowest point, there's a stop. There we go. We're out. That was a $300 trade. It's not so bad. And now we're out. No more momentum. Rule number 1's not met. Guys, when you know your rules, this is exactly how you'll do it. If then. If this happens, then I'll do that. If this happens, then I'll do that. If this happens, then I'll do that. And the more in tune you get with that concept, the easier trading becomes. You guys will never hear me stressed out in a trade because I know if I enter the market has a better chance of winning than losing. Then it's just up to me to manage it. Take what the market gives me. Act in my own best interest. That's day trading, my friends. And you will mess it up. No doubt in my mind. You'll make mistakes. With weak triggers, anything can happen. And look, anything happened. And once I got to the wrong side of the triggers, I don't know if, when, or where the market's going to stop. Every lesson from the first hour of this classroom just came true. All of them. All right. What can I do for you guys? running out of breath. Do we learn anything today? I like to ask that. Did you know that most days you won't realize that you learned something? Most days you had no idea that you learned something, and then you have this aha moment where it clicks. You have that, oh man, I've seen this, I've heard this. That happens a lot. Pete makes it look easy, but you said he has studied a bit. He's been posting in the room for 10 years. And did you guys know that there are so many people in Nexgen with that X and V next to their names that walked away for just a little bit. That said, you know what, I'm going to do it my way. And then when their way doesn't work, sometimes you got to take a big, deep breath and say, okay, my way is not working. Maybe I should try it the way that the guy that's been teaching for 30 years, well, the company that's been teaching for 30 years teaches it. We're all egomaniacs, right? Stick to the trend trades. Not all your trades that you thought were trend trades, which is great to know. I like that, Paul. And if you're looking at a checklist, you'll always know, right? You'll be able to see the difference clearly. You'll say, this is a pullback to an area inside of triggers, right? This is jumping the fudge in because I hope it goes. This is jumping the fudge in because I hope it goes. So you'll begin through repetition to know that this isn't a trend trade. Can't be managed like a trend trade. This isn't a trend trade. Can't be managed like a trend trade. This is a trend trade. Has to be managed like a trend trade. So when you name your trades, guys, you know how to manage them. When you say, I'm going to take the high probability trend trade and the rules are met for it, I want to show you something from the KISS plan. We all make mistakes, Pete. But I want you to see this. This is from the KISS plan, guys. If I take the entry for the high probability trend trade, I have a 100% written out plan of attack for that trade. If I take a 50-50 trade, I have a 100% plan of attack to manage that trade. And what new users tend to do is they will do this. Let me find it real quick. This is called exit conditions. Is they'll take a momentum trade and manage it like a high probability trend trade. Or they'll take a 50-50 trade and manage it like a high probability trend trade. Or even worse, they'll take a high probability trend trade and manage it like a 50-50 trade. Guys, the more you add to your plate, the more you have to think about in the moment. So you guys that jump the fudge in, believing it's a trend trade, are already set up for failure on your management. You guys that are relying only on momentum, but trading it like it is a trend trade, you're setting yourself up for failure. And if you are taking the perfect trade and you're managing it with fear or a different plan, you're not getting the most out of those trades. Realize that Pete just giving me a hard time, but you're an awesome trader. Pete posts more than anybody in this room, I think. I really do. I think Pete posts more than anybody in this room. And guys, the longer you're here, the more it feels like we have a relationship. I feel like I know Pete. I've never met Pete. Paul, I feel like I know you, and there's a lot of you in this room. I feel like we could meet at a restaurant, have a dinner and a conversation, and never miss a beat like we'd always known each other. But that being said, just because I like you, right? Just because I feel like we have that little bit of a relationship, that doesn't absolve you from the feedback that will make you a better trader. I won't say, "Oh, you broke all the rules. That's okay. You're pretty cool." I'm going to say, "Hey, this is counterproductive to your success." Just like you would do with a friend, right? Once the momentum goes away, I'll be darned, the market goes down. Don't know if, when, or where. Do you guys see it? Don't know if, when, or where. Some of you caught this one. That's a pretty popular trade. 1146. Let me go ahead and I'll end today's broadcast.